Hello and welcome to Advanced Projections February 2021 Economic Report. I want to say something in advance of actually going through our script, which is that this month's report contains 5 charts, 5 graphics that you really should take a look at. And we reference them here within the text of our report. But of course, to see them, you need to look at the written material found on our website. All right, so now for our forecast reviews. Continuing U.S. political drama, the slow initial COVID vaccine rollouts, and amidst threats of more rapidly spreading mutations, the new U.S. administration has its hands full in the first 100-day honeymoon period. In fact, it looks like anything but a honeymoon, with no apparent reasons for near-term exuberance. New substantive stimulus is still hung up within political negotiations, and it may take until the end of March before all resolutions and necessary steps would permit any further payouts to occur. As we said through our last 3 months' reports, Recession 2020 has technically ended. There is now clear and rampant speculative excesses in the equities markets and elsewhere, such as in cryptocurrencies and some precious metals. Real estate prices have advanced sharply in upper-end housing. Margin borrowing hit a new record high in December. That's the latest data that we have, and it is sure to have climbed even more since then. The party in equities continues, but we're pretty sure most of the partiers are now fully inebriated. Now for the underlying socioeconomic situation. We said last month that our expectations for COVID cases and fatality tolls would continue increasing for many months into 2021. As of now, February 10th, 2021, U.S. cases reached 27.2 million, an increase of more than 5.2 million in the past month, and compares favorably, actually, to an increase of 6.3 million in the previous month. New cases have soundly passed the rate of 220,000 daily, last month being 200,000. And U.S. fatalities have reached 468,000, up approximately 96,000 in just 1 month. That's up 26% versus the prior month's increase of 26% also. Fatality rates, which are fatalities divided by cases, are 1.3% based upon average daily infection rates at the end of November compared to average daily fatality rates 4 weeks later. If we use the ratio of total fatalities divided by total resolved cases, the rate is much closer to 2.6%, about a 10% decline in fatality rate since the beginning of the year. These small improvements are good to see, and perhaps the mass psychology is now embracing more vigilance as vaccinations are at least on the horizon for most of the high-risk population. As of this writing, about 10% of the U.S. population has received at least 1 dose of vaccine, and a quarter of those have received their second doses. More highly transmissive strains have been identified as incoming from Great Britain, Brazil, and South Africa, with cases of those forms appearing in the U.S. as early as November. We are now well into our 3rd wave, one ahead of most of the rest of the world, and still at the top of both the total cases and total fatalities lists. In spite of having only 5% of the global population, we still have more than 25% of the global cases and 20% of the global fatalities. Global cases have reached 107 million, up drastically by 19 million in just the past month. At this moment, there are still over 550,000 new cases being reported daily. Global fatalities have now solidly reached past 2.3 million and will certainly hit 3 million by the end of March. We've already discussed the downplay and happy talk surrounding the pandemic situation. Vaccine test results and slowly increasing deployments have added to the optimistic talk. However, it would still be on the very optimistic side to presume that under the best of circumstances, it will be at least the end of first quarter 2021 or later before large numbers, i.e. several tens of millions of people, will have been given 2 doses of one of the vaccines currently approved or others still under trial, and that it will be much later in 2021 for a fully implemented national vaccination program. Convincing enough people to get the vaccination will come into play. Only 70 million got their seasonal flu shot over the past few months, so perhaps 100 million Americans, or 30% of the population, will be ready and willing to receive one of the new vaccines, leaving 230 million as fertile territory for keeping the pandemic active. As of this writing, about 32 million, or 10%, have received their first dose of vaccine. We are expecting continuing improvements now in rollouts and mass vaccination efforts. The goal is to have 90% of the population eventually vaccinated, but even 75%, if achieved, is enough to end the most serious threats, assuming the most vulnerable portion of the population achieves vaccination rates well into the 90%. Other vaccinations or vaccines have yet to be approved, but when that happens, we may be able to reach 25% of the population by early spring. A useful figure for achieving widespread control of the pandemic is having at least 60% of the population vaccinated and much greater compliance to actually eradicate it. 60% coverage would mean acquiring and distributing 400 million doses. Doing this 24/7 for 1.5 million doses per day still means at least 5 more months. Not an easy program to undertake and then actually attain the necessary compliance numbers. We are just now catching up to the promised vaccination rates, and after seeing large improvements during late January and early February, we expect to see slight increases in the daily vaccination rates. A curve we have been using since it was created on November 20th of last year and have then been modifying periodically shows the danger in letting the pandemic resume its havoc. We are still running above this original projection in terms of the actual fatalities versus the 2020 model. So we'll have to wait and see for another couple of months if the problem is truly being solved, as would be evidenced by actual fatalities declining below the curve. You'll note that in the chart we showed a 1-year projection for fatalities at 440,000, and we're now well past that number and probably will exceed it by 10% by the first anniversary of the first COVID fatality, which would be March 1st of this year. Now, the current economic environment. In January, unemployment levels ticked down a hair, holding at a national level of 6.7% after a minuscule monthly gain of less than 50,000 jobs. As we have been anticipating for several months, return to work gains have flattened as outdoor seasonal and holiday work hours decline further. That is clearly illustrated in yet another chart, courtesy of the New York Times, based upon U.S. Bureau of Labor statistics, which are dated through February 5th. Our view is that this flat spot will last for a few more months, and then job gains will begin to return much more slowly, taking 18 to 24 months more to erase all of the remaining 10 million job losses that have been created by the pandemic. Equities markets have continued to power ahead, with more volatility getting ever deeper into bubble territory. There are now increasing warnings being put out in the financial press as well as by indicators utilized by investment bankers that warn of a corrective environment that has formed for equities. We still concur, but cannot really say exactly when the new market highs will stop forming. Fourth quarter of last year and annual corporate earnings reports have been coming out over the past month, with little evidence of systemic weaknesses. It is likely that fourth quarter year-over-year total earnings for the S&P 500 could be up about 1.5%, which is strong given the circumstances, but it is hardly anywhere near the amount that would justify the leap in equities prices over that same one-year period. Strong fourth quarter performances occurred in the financial, IT, and communication sectors, and the continuing weaknesses were found in energy, industry manufacturing, and hospitality, which can only improve slowly from here. Now, our individual AP indicators are as follows. Our APSI indicator looks at the relationship between current month-end S&P 500 equity closes and the ones from 4 months back, as well as comparisons to a set of long-term growth rates and the GDP itself. A few months ago, we published twice about the 3 indicators we use to establish whether the markets have entered bubble territory. Now, new highs have been occurring rather consistently within the past several weeks. In spite of fourth quarter earnings improving a bit more than initially expected, the PE ratio of the S&P 500 continues to increase further beyond a doubling of where it should be under normal circumstances. If this index were to remain absolutely flat at today's 3,900, the index annual corporate earnings would have to increase year over year by roughly 25% for 3 solid years just to get back to realistic index valuations with a trailing PE of less than 20. That is an unrealistic expectation, to put it mildly. To a degree, this chart, courtesy of FactSet, illustrates this particular problem. Note that FactSet currently predicts only 22% earnings growth for 2021. Note that the last 2 significant gaps preceded large market corrections, whether corporate earnings were increasing or declining. Now we are looking at a third new large gap. We continue watching market performance and growing margin borrowing levels, which is our favorite tool for tracking speculative excess. The last peaks in margin borrowing showed up before the 2 large corrections of 2018, both of which we predicted. During recession 2020, margin debt increased by nearly 50%, absolutely flying in the face of the consequences of a recession and ignoring realistic prospects for the economy going forward. From a $665 billion level in October of last year, margin debt was a mere $35 billion away from its all-time high of $700 billion, set at the end of 2017. And that's about where it was when we warned of the first market correction of 2018. During November of last year, margin borrowing penetrated those record levels and is now at historic highs, with the reported level from December being $750 billion, up another $50 billion. Circumstances are vastly different from 2018's interest rate environment, but heavy margin borrowing that is synchronized with markets making significant new highs is a likely driver for a market correction beginning soon. Last time we said this, the correction began within 3 months, and it came in 2 waves during 2018. The latest information on margin debt is from December and is shown in a fresh chart from Advisor Perspectives, but we expect further large increases in this to have appeared in January. Under similar circumstances seen in this chart, 2 blue index drops of 50% of real value followed shortly after each major correction began. A similar size drop now would take the S&P 500 index to well below 2,000. Note that matchups where the red and blue curves intersect have taken place 6 to 9 months prior to the last 3 recessions. We are there again. January's closing value for the S&P 500 keeps our APSI indication as red, with that index moving even further into blatantly overheated territory during the first week of February. Another primary indication of the top-heavy nature in equities is the spread between the S&P 500 and 10% of the GDP, which continues to grow as shown here in our third chart. We see this as an indication that more and more of our GDP is being tied up in speculative activities rather than solidly productive activities, that is, goods and services. This is our form of what is widely considered to be the Buffett indicator, and the upper smooth curve is the boundary between a warm market and a bubble zone. Now for our other indicator status. The AP-MS money supply indicator remains solidly green as the Fed continues with their expansion of the money supply, now reaching $19.4 trillion, up 23% since the beginning of 2020. It has also continued to warn Congress that the bottom layers of the economy are still suffering, and the whole economy will suffer lackluster growth if no new and significant stimulus is injected there. Additional stimulus has been dangling in front of us now for weeks. Negotiations on further stimulus are moving a bit faster now, and we have some expectation that a meaningful, real stimulus may arrive by late March. But the pitifully small $600 individual payments from December will do almost nothing to restoke the economy. Traditional precious metals have steadied now. Gold set an interim high above $1,900 an ounce in early January, but failed to push higher and test August's temporary move above $2,000. Recent action in gold prices show testing of and strong rebounding from support levels in the mid-1700s. Silver behaved similarly during December and January, moving up and down in the $25 to $27 range. Rhodium has moved up to new all-time high levels as speculators continue to move in strongly, pushing prices past $16,000 per ounce in January and now at over $19,000 per ounce. Platinum has now advanced to about double its low set in mid-2019 and could be the next target for speculation. Month-end prices for gold and rhodium keep our AP precious metal indicator deeply into the red. The October LEIs from the Conference Board again improved slightly, and for this report, our AP LI indicator stays at yellow now for 3 months in a row. We still expect lackluster LEIs to continue during the next few months. The Conference Board also continues to warn of a weak recovery and that we should expect a weak economy well into 2021. Our APYC indicator moved to green for the first time since May of 2018. That's well over 2 years. All Treasury short-term yields from 1 month through 2 years dropped slightly compared to last month, while the 10-year yield moved up from 0.93% to 1.12%. This is indicative of a bit more confidence in the economy near term, with increasing demand for borrowing virtually interest-free in the short terms. Long term, this is not a sustainable paradigm. Should any other potholes occur in the road to recovery, the Fed now has little room to do anything on its own to re-stimulate. The Federal Reserve's weekly aggregate measure of economic stability remains in the position of relative safety, but the Fed itself has stayed with the NBER declaration of recession within all of their datasets. Fed charts for other data that we observe clearly show that they have not cleared the bottom of the recession, and recession 2020 is now 10 months in extent per the NBER. Therefore, our APFD indicator for this report remains red now for 9 straight months. This may change shortly. Because as the third quarter 2020 GDP grew substantially upward from its enormous decline in the first half of 2020, their traditional measure and definitions of recession have now pointed to a technical end of recession 2020. The NBER nor the Federal Reserve have yet to take official notice of this technical end. However, advanced projections declared earlier that recession 2020 had ended approximately 8 months after it began. But we do maintain an ominous note here. The root cause of the massive collapse that characterized the onset of recession 2020 has not gone away. The economy now is much weaker than it was in January 2020 before COVID hit our shores. Now, in a large third wave, COVID is still spreading rapidly. Control of this situation will determine if there is a second GDP dip and perhaps a recession 2021. Real-time events will determine this, as the majority of our standard set of indicators have not yet returned to green states, nor do we expect them to do so for many, many months. We will have to basically rely on a direct watch of public health statistics, unemployment figures, GDP, velocity of money, and financial stability indices for several more months, which are in and of themselves inherently less reliable short-term indicators. So in summary, only 2 of our 6 indicators are in green territory. We are reflecting that in our slightly lowered probability of another near-term recession to 70%. We calculated that the actual onset of a recession had already begun over 11 months ago, in fact, a fact which was then confirmed by the NBER in June of 2020, and it became officially acknowledged by the Federal Reserve later in the summer with the adoption of the NBER's declaration within Federal Reserve datasets. However, as we just noted above in bold text, the technical end of recession 2020 has already occurred late in the third quarter of 2020. Further modifications to this scenario will depend on what happens in the days and weeks ahead. Reviewing the events leading up to the Great Recession, there was a brief rebound before the serious declines of late 2008, within the context of an unbelievably risky economy, just as we are facing now. Just like then, we have now almost concluded an election which portends a large shift in administrative policies. This time, there is the unique backdrop of a worsening pandemic and an ongoing, highly divisive political manipulation of social and economic expectations. The events of January 6th are clear proof that this divisiveness and manipulation are not trivial matters. We maintain that this is a very risky equity market environment with potential for significant and protracted drops, or even with a flash crash based upon the disparities shown in our charts this month. Only those with the highest tolerances for risk should be speculating in the equities markets at these levels. Highly speculative valuations never persist, and a return to the mean or worse becomes more likely with each new disruptive influence. The only moderating influence in this scenario is that the Federal Reserve has indicated a long-term near-zero interest rate environment, and that tends to fan the fires of market speculation. This situation could persist for a couple of years, or some new black swan event could arrive to pop this bubble in short order. What we continue to ponder here at AP is the economic setup for the 2020s. Is it possible for history to repeat itself and that we could expect to experience another roaring 20s as public relief and optimism take over once COVID is truly behind us? And despite the glossy reputation of the 1920s, there were 3 recessions in it before the big one, the Great Depression of 1929. Well, that's all we have for this month. Thanks for listening. We know it's been a long report. There's been a lot happening, and the background continues to show more volatility and uncertainty. So that's why we came up with the extended report. When things are back to all green, the reports will be much shorter and concise. Thank you, and we'll talk to you in March.